Good afternoon. Welcome to today's webinar, the 2020 Mid-Year Recap on Private Placements. To register for upcoming AI Insight events and other industry events, visit News and Events section on AIinsight.com. To visit our past events, go to Webinar and Podcast page on AIinsight.com. Now I'll introduce Laura Sexton, Senior Director of Program Management. Laura?
Thanks, Jen. And thank you all for taking the time to listen in for our recap of what happened in the private placement markets in the first half of 2020, which hopefully is one of the most turbulent first half of the year we all ever experience, hopefully. But before we start, I want to mention that everything we cover is based on our industry reports, which we publish as part of our financial performance reporting on AIinsight.com. We publish our private placement market report once a month around the first week of each month. And then we publish non-traded REIT and BDC reports once a quarter and an interval fund report every 6 months to give subscribers insight into the funds that we cover. So the data for our industry reports comes directly from the funds that we cover on our platform, which at this point includes 171 private placements, 85 alternative strategy mutual funds, 16 open and 42 closed non-traded REITs, and 23 open and 16 closed alternative strategy mutual funds. So with that, by way of an agenda, I'll review what we're seeing in the broader private markets outside of just our coverage, and then the trends we're seeing here at AI Insight. We'll look at trends in 1031s, opportunity zones, other real estate, and some of the niche private placement strategies that we cover. So I'm going to start with some of the overall market trends, which I think is really important to look at, kind of to put in context what we're seeing here at AI Insight. So in terms of overall trends, we've been seeing this trend for a while now, the shift from public markets to private markets, due to many factors, including, among others, the fact that the newer, faster-growing, tech-focused companies out there need the flexibility of private capital as opposed to the restrictions of public capital. So this is kind of not new. I mean, AUM in the private equity market is up 170% over the last decade, and the number of PE firms more than doubled over that time period. And over that same time period, public market AUM is flat and is actually down 40% since 2000. 2019 was actually a record year with fundraising for the private markets, with fundraising at an all-time high, as you can see on this chart, which is published by Preqim. So with all of that, and after the decade of growth in the private markets, and despite the kind of challenges here with COVID-19 at the end, dry powder in the private markets is at an all-time high, with estimates of around $2.6 trillion in unspent capital out there. So what's interesting is that this is more than double the amount than at the beginning of the GFC, the Great Financial Crisis, which is positive for the health of companies that need capital, but as we'll talk later, could cause more muted returns for investors in this go-around. So, of course, 2019 was a record year, and there is capital out there, but there is still a big slowdown in the first couple of quarters this year. As you can see here by the chart on the right here, published by Bain Capital, fundraising was down across all categories and deal activity down in Q1 and Q2. Private real estate growth and distressed fundraising, which makes sense, took a larger share of this pie in the second quarter. And the mood was improving in recent months. I mean, deal activity and fundraising recovered in June. There was some movement in the markets as the economy started to open up. Valuations were at least a little bit more reliable, not too much. We'll talk about that more later again too, but clearly a significant amount of uncertainty remains in what happens with COVID-19. So in terms of other trends out there in the broader private markets and some of the themes in the research that we're seeing, I mentioned this before, but there's a theory that returns for funds put together this year could be a little more muted than the prior recovery due to the competition from all of that dry powder out there, and due to longer time horizons, since there's still so much uncertainty and firms are really taking it slow and making investments. It's hard to analyze those cash flows and have any certainty in them when there's so much uncertainty out there. And valuations really aren't distressed yet in most sectors, and we haven't seen a lot of distress other than kind of pockets that we'll discuss. So you're not seeing the types of deals you did in the prior recession. But with fundraising down, the time on the market for funds is a little longer than 2019. And we've seen, and despite the lack of distress, other than in specific pockets, there's definitely a greater focus on distress and more so, I'd say, on value-added opportunities. And in fact, some stats on what's going on in kind of value-added and distressed. You have a record level of dry powder in distressed private equity and debt. You have a record number of distressed debt funds in the market. And the largest firms are raising capital, record capital, and exceeding their targets in their value-added and distressed funds as well. And then another theme we've seen that's kind of been brought about by everything that's happening this year is a focus on socially responsible and ESG. That's definitely, ramping up, something that has been for a while, but ramping up a little more with us. So moving on to talk about the trends that we're seeing here at AI Insight in the private placements on our platform, really kind of mirrors what we're seeing in the broader private placement market. So we had a very strong Q1, actually continued record pace into January and February, and March slowed a little, but of course this was followed by a very slow Q2, especially not surprisingly in April and May. We then saw a moderate acceleration in June in terms of the number of new funds added to our coverage, led by 1031s and opportunistic funds, but I think July is going to be another slow month in terms of private placements. So here's an overview of our coverage and the trends year over year. As you can see by the numbers circled, we're down close to 4% in terms of the number of new funds added and down almost 29% in terms of the aggregate raise. So we're seeing smaller funds launching this year. So this is an overview of our coverage so you can see the breakdown of the funds out there. The chart on the left here shows coverage in terms of the percent of the number of funds as measured by the largest components. The largest components are 1031s in the dark blue and other real estate LLCs and LPs in the lighter blue. So in terms of the number of funds, real estate is definitely the largest percentage. But then on the right side, this is our coverage as measured by the percent of the target raise or AUM. And as measured by that, although we don't have a lot of private equity and debt funds that we cover, they're bigger. So they measure about 27% of the total target of the private placements we cover. And other real estate is still a large component, as well as opportunity zone funds. So this is our coverage by registration form and general objective. And as you can see on the left, the private placements we cover are primarily registered under 506B, about 13% of the funds under 506C, and 12% just under D that haven't reported B or C yet. So we've seen more 506C, especially in the opportunity zone sector, but also within 1031s. That percentage of the 506C that we cover was in the single digits early last year and is now, as you can see, up closer to the mid-teens. So on the right side by objective, you'll see the majority of our private placements are focused on income at 52% of funds. Growth is next at 30. That's kind of growing this year a little bit. Growth in income at 17%, and a very small component of funds with capital preservation as the primary general objective. So in terms of trends within our coverage, we had 77 funds, private placement funds, added to our coverage in the first half of 2020, which is down slightly year over year. Again, as I mentioned earlier, the funds are a little smaller. Average targets are down about 29%, smaller average fund size out there. So when we look at funds that closed their offerings, and these private placements, 88 private placements closed in 2020. Sorry, this is 2020. Having raised 67% of their target, 30 of the 88 funds met or exceeded their target, which is actually different than the broader private placement markets, where in the first half, Preqin reported that 67% of funds that closed met or exceeded targets. So our coverage is a little lower than that with 30 of the 88, not quite as high as the broader market. So in terms of our current coverage, 171 funds that we cover currently raising capital with an aggregate target raise of $16.6 billion and an aggregate reported raise so far of $8.4 billion, which is about 51% of their target. The average fund size of the private placements that we cover is $97.1 million, and this ranges anywhere from very small funds of $3.5 million all the way up to $2.7 billion. And of course, we have had some suspensions during the first half of the year due to COVID-19. We saw 5 private placements suspended and 1 offering terminated due to uncertainties related to COVID-19, mostly around valuations, but also so they could focus on existing assets within portfolios. And so far, we haven't seen any of those, at least on the private placement side, reopen to new investments, but we're keeping an eye on it. And we have a report on our website that you can click on to see the activity in terms of what's happening due to COVID-19. So now we're going to switch gears and talk a little bit about trends in the real estate categories, including our 1031s, LLCs, and LPs, and opportunity zones. But before we do that, as with the broader private placement markets, let's take a look at trends in the private real estate markets overall that we're seeing. So as with the broader private placement markets, private real estate transaction activity is down about 48% in Q2 from Q1 and way down from last year. So this was just released. I don't know if you read the article that was just released today. The latest data from CoStar and Real Capital Analytics shows that activity was down almost 70% year over year. And the outlook for this is that sluggishness will continue until cash flows can be more properly assessed. So very few transactions. The average value per deal is down to the lowest level in 5 years, as illustrated by the frequent slide on the left. And when you look further into transactions at the sector level, you see that industrial, which we'll talk about, is considered the strongest sector. Even that, transactions are down 25%. So even in the strong sector, you're down 25%. Well, on the other end of the spectrum, office and retail transactions are down 62% and 72% respectively. So not a lot of transactions. So the other interesting thing happening is the average value of the deals and some shifts there. So, office has historically dominated really just due to the size of the bigger buildings that sell, but because there really haven't been any kind of marquee sales this year, multifamily actually eclipsed office in the second quarter in terms of the aggregate value of assets. Kind of an interesting dynamic happening. A few other trends include the fact that there are fewer funds in the market than last year, but fundraising actually remains strong and pretty concentrated in the biggest managers, including Blackstone, which we've actually seen on the non-traded REIT side, so trends similar to what we've seen. Value-added and opportunistic strategies raised the most in Q2 2020. Not necessarily distressed, because there hasn't been as much distress yet in real estate. There's probably more yet to come, but certainly less focus on core than usual. And also, as in the broader private markets, there's record dry powder in private real estate funds as of July 2020, about $204 billion. So plenty of capital out there, which means additional competition. So in terms of the real estate sectors, it's clear that there are clearly, no sectors that will escape the impact of COVID-19. I mean, skipping down to the last bullet point here on this page, according to MSCI, which put together a scenario analysis of the real estate market pricing using a base case, best case, and worst case, with the timing of the pandemic as kind of the biggest variable. Real estate values are set to decline anywhere between 13% and 37%. Again, really depending on how long the pandemic lasts and the severity of it. So that, of course, is an average, but still a pretty significant downturn in private market values that really has yet to occur because of the lack of transactions. As it always is, the different sectors within real estate are reacting very differently based on their exposure to the impact of the pandemic. Industrial is positioned to outperform, as e-commerce has basically sped up about 3 to 5 years within a couple months. Really interesting things happening there. There will be more focus on the supply chain, which will be increased to be more resilient as opposed to efficient, which means more space needed. So industrial is kind of the beneficiary of this. Retail clearly has taken a direct hit, and the performance of individual retail assets will depend entirely on location and proximity to necessity retail. Mall owners received a quarter of their rents in April, and that was while they were fully shut down. And the data is still coming in on how they're faring with reopening. One interesting trend in retail is that older, obsolete retail is being turned into last-mile distribution centers. Again, with the whole focus on e-commerce, that means that distribution needs to be closer to the end client. So this is a strategy being used, which makes total sense for some of those retail centers that will probably never recover in the retail format. Retail and hotels are where the most distress is happening already. According to Real Capital Analytics, the number of distressed properties in retail is double the normal quarterly average, similar to where it was during the financial crisis. The multifamily remains strong. People still need houses, and even though you may see a slight shift away from major markets, the consensus is this is a short-term trend. Renters may look to properties with larger footprints in kind of the urban core, although building apartments with larger footprints may not be feasible from a cost standpoint. But at any rate, multifamily remains one of the stronger sectors at this point anyways. Well, people really aren't moving yet. In another area, office dynamics really haven't moved as much yet, mostly because they tend to lag with longer-term leases. And the consensus is that the results of how things all fall out may be mixed. If remote work trends are offset by the need for more space per employee for health reasons. You could have kind of, more muted results, less down because you need more space. I mean, densification has been a trend over the last several years, but that's going to need to stop, at least in the, the short to intermediate term. And it's interesting here that the work from home trend has been happening over the last few years with technology increasing, and this pandemic just sped up the process by about 5 to 10 years and putting that in the forefront. In fact, Google just announced yesterday that employees will be working from home now until June of 2021, and so this definitely speeds that phenomenon up and certainly changes the picture for office. Hotels have seen the most distress, actually, really one of the few areas to really see a lot of distress so far than in retail. Economy hotels most likely the first to recover. Most sectors are now opened up, but with all the travel restrictions in place, there's still a long road ahead. And the other trend out there is that lenders are being cooperative for the most part so far. I mean, tenants and property owners are reporting that they are working together quickly and aggressively to do what's best. There's consensus out there that this is one of the most cooperative downturns many people have seen. But again, the ability to continue to do this going forward depends on how long the pandemic lasts and the severity of it, especially into the fall and the winter. So now let's turn to 1031 trends. And in terms of our coverage, we had a strong Q1 in terms of new fund formation, the funds added to our coverage and target raise. We were actually on track in Q1 to exceed the record of 2019, but then, of course, this was followed by basically anemic April and May. Activity accelerated again in June with more 1031s added than the prior couple of months, but it's still roughly half of pre-COVID levels. July slowed again, actually even slower than April and May in terms of what we're seeing. That data will come out in a couple of days, but I think it's actually going to be even slower than April and May, so not a lot of 1031 activity. The funds that have been added to our coverage this year are smaller. They have about an 18% lower average target than 2019. So this is something that we are expecting, given that the fact that the larger DSTs are financed by CMBS that aren't able to happen with CMBS markets not moving all that much. So in terms of sectors, multifamily remains the dominant sector in terms of the number of funds and the coverage, although recent funds we've seen have been pretty diversified, and in fact, we're reviewing a medical office fund, which we haven't seen for a while, and a couple of other sectors. We've seen a little bit more diversity in terms of the sectors other than multifamily, but it's still dominant. And average pro forma year one cash-on-cash returns and LTVs are modestly higher than year-end 2019, but not materially. So looking at a few other trends in coverage, we currently cover 62 open 1031s raising capital with an aggregate target raise of $2.1 billion and an aggregate reported raise of $1.5 billion, or approximately 55% of their target raise. There's $600 million in available equity at this point, which is down from about $1 billion in available equity at the end of Q1, so a little less availability. In terms of average fees, the upfront selling commission average is 5.79% for the 1031s we cover, ranging from 5 to 6.55%. The average net proceeds is 90.35, ranging from about 86.5 to 93.41. And the average liquidation fee is 2.96, ranging from 0 all the way up to 8.5%. But those fees really haven't moved much in the last couple of years. 52 1031s closed in 2020. They were on the market for an average of 276 days, and they raised 99% of their target. So moving on now then to talk about the non-1031 real estate LPs and LLCs that we cover, where we've seen a slowdown, and we had seen it even before COVID-19. We added 14 new funds to our coverage in the first half of 2020. And this is really, we've seen a little bit of a shift to opportunity zone funds, which were new in 2019. They do continue to absorb a significant amount of the market share on the real estate side. So we've seen slowdown here, but continued kind of, strength on the opportunity zone side. So in terms of other trends, the more recent funds that we've seen have been focused on distressed real estate debt and value added and other properties similar to the trend in the broader private markets with that focus on value add, opportunistic, and a little bit of distress. The 15 funds we added in 2020 were all actually offered by 15 separate sponsors, so definitely no dominant sponsor here. The average target raise of the funds added in 2020 was $65.9 million, ranging from $4.6 million up to $200 million. 23 non-1031 real estate private placements have closed in 2020. Those funds were on the market an average of 551 days, so much longer than the 1031s, and actually only raised or reported that they raised about 55% of their target, which is actually similar to last year's levels. So these funds tend to be a little bit bigger, may target more than they actually need. They tend to close before they raise their target. So in terms of current coverage, we currently have 50 non-1031 real estate private placements on our platform, with an aggregate target raise of $5.8 billion and an aggregate reported raise of $1.3 billion, or 23% of target, and 3 real estate private placements suspended offerings and 1 terminated due to COVID-19 concerns. And as I mentioned earlier, we haven't seen the 3 other ones open yet, but we'll keep an eye on it for sure. All right, so now switching to opportunity zone trends. We've added 7 new QOZ funds in the first half of 2020, which is below last year over year. We did add 1 QOZ fund in July, and 2 are in the queue. I think we'll still, after that, we still may be down a little bit year over year, but not that much once those filter through. In terms of funds that closed, 1 large energy-focused QOZ fund closed in April, and this was the only QOZ fund we covered that wasn't a real estate-focused fund. Remember, QOZ funds can be assets other than just real estate. We've just seen a lot of the real estate-focused one, but this one wasn't. Obviously, energy has had a difficult year. It closed earlier than expected due to the market uncertainty, and it raised approximately 22% of its $400 million target and was on the market for about 315 days. 3 other QOZ funds closed in 2020. 2 of those funds reported that they raised 100% of their target, and the 3rd larger fund exited the market prior to raising capital and prior to any COVID-19 related issues. So the SEC did provide pandemic-related guidance for opportunity zones in early June, extending the investment period, asset test, improvement, and safe harbor timelines. So we may see more of these than expected this year, but I think as with all other real estate, there's a lot of uncertainty affecting investment in QOZs because they have to look at cash flow just like everybody else does. So in terms of coverage, we currently have 19 QOZ funds that we cover looking to raise $2.5 billion. They've raised $981.9 billion, or 39% of target, so there's about $1.5 billion in equity remaining. The fund size here ranges from $6.4 million to $500 million, and the investment focus within the QOZ category varies from specific to broad, so there's a pretty good mix of options. We've got sectors that include hospitality, multifamily, diversified, mixed use, blind pool, and very specified projects. The smaller funds tend to be the ones focused on a specific project, while the larger funds are more diversified in terms of their geography and sector, which makes sense. I mean, geographic focus includes anywhere from California, Salt Lake City, Utah, St. Paul, Minnesota, Virginia Beach, Richmond, all the way up through the whole United States. So a pretty big variety in our opportunity zone offerings that we cover here. So switching now to some of the niche categories that we cover, starting with energy, which was slow in the first half of 2020, but actually seems to be ramping up just a little bit here in the second half, and especially recently. So the funds that we've added to our coverage this year have primarily been focused on mineral rights, although recent funds do include drilling and opportunistic strategies. We've had 4 new funds added this year, on par with last year over year, but they're a little smaller in target. We've had 3 in the queue right now, so we may end up ahead after those funds filter through this month. So in terms of our current coverage, we've covered 9 energy funds raising capital with an aggregate target raise of $442.1 million and an aggregate reported raise of $55.5 million, or 13% of their target raise. The average fees for the LPs, the energy LPs, because we've got LPs and LLCs in this category, average upfront for the LPs is 6.6%. LLCs, the average is a little lower at 2.4%. The average net proceeds is 87.4%, ranging from 85.5 to 90. Revenue sharing, the average there is 28.33%, and that ranges anywhere from 15% to 50% in terms of the hurdle before management participates in fees. So 2 energy funds closed in 2020. They were on the market for an average of 294 days. They reported an average raise of 12% of their target. However, I will say here they didn't report their final raise to us, so this number could be off. They could have raised a little bit more before they closed. So now looking at some of the other energy trends out there, clearly this has been a tough year for the sector. The combo of a trade war and the pandemic caused West Texas crude prices to go negative for the first time ever in April. So according to Preqin, energy fundraising hit an all-time low in Q2 2020, and actually investors are reducing their allocation to energy going forward. The outlook for pricing is actually positive at this point as the supply side stabilizes and demand returns. The duration of the pandemic, clearly a key variable as it is with everything else, and pricing is expected to be much lower than it has been. So in a recent report by J.P. Morgan, they predict $34 a barrel pricing towards year-end 2020. They state that risk premium is higher based on greater supply uncertainty and lower bounds on price. Exploration and production is largely uninvestable for the immediate term as prices have fallen below marginal shale economics. So a lot of challenges in the energy industry, but I think we've seen a little bit of fund formation as prices have kind of hit a point where they're an inflection point. So we may see a few additions to that category this year. So moving on now to conservation easements, another area that's been pretty slow, although actually last year ended up just about 10% below the prior year, so not disastrous in terms of new funds. One new conservation fund has been added to our coverage in 2020, which is on par with the trend in 2019. There's no funds in the queue right now, but with this sector, the tax focus, the segment typically ramps up later in the year. 2019 was no exception with 17 of the 23 funds added actually in Q4, so this most likely will ramp up later in the year. Moving on to the next sector we cover here, private preferred funds. This has always been a smaller area of focus just because there hasn't historically been a lot of demand from our subscriber base, at least for preferred private placements. There's more demand on the public side, but it has ramped up. So we've added 4 new private preferred funds in 2020, much higher than 2019 actually. And in terms of our current coverage, we cover 6 private preferred funds with an aggregate target raise of $403.3 million and an aggregate reported raise of $152.2 million, or 39% of target. And additionally, we cover 5 public preferred programs. And lastly, but not least, private equity and debt, another area that has been historically slow in terms of the funds added, but it's ramped up, especially in light of COVID-19 here. We have actually added 5 new private equity or debt funds to our coverage in the first half of 2020, which is up 25% in terms of the number of funds, and the target raise is up 129% year over year. So certainly seeing a little bit of a ramp here, which makes sense. One private equity fund suspended its offering due to COVID-19 uncertainties. It hasn't restarted yet at this point. And in terms of current coverage on our platform, we cover 14 private equity and debt funds currently raising capital with an aggregate target raise of $4.5 billion and a reported raise of $3.9 billion, or 87% of target. So that actually completes our review of the private placements we cover and some of the trends that we're seeing. So as I mentioned earlier, our industry reports and the underlying data for the funds we cover are available on our user website. We will be sending the replay of this to you all in case you missed anything or if I talk too fast in my very East Coast way of talking. But if you have any questions, definitely feel free to reach out to our amazing customer care team. Thank you again so much for listening in. I know everyone's doing more than ever these days, so thank you, and wishing you and your families good health. Thank you.